This is Matthew Cratter from Trader University, and today I want to answer the question, does Fed money printing actually cause inflation? If you're interested in learning how the economy actually works, how central banks actually work, so you can make money in both bull and bear markets and understand what's going on in our very fragile economy, or if you just want to see what I'm trading or investing in, be sure to hit that subscribe button. So this video is made in response to a really good question I got from D Midnight Rider about Fed money printing not actually being money printing, quantitative easing not being money printing. So I wanted to run through this. There are a number of details that I have not covered in previous videos. So to begin with, we really need to ask ourselves, where does the US government get its money from? And I'm talking about the federal government. The main way, obviously, that they've traditionally gotten money for their spending is through taxes. The other two ways are selling government bonds, which are called treasuries. And you can either sell government bonds, you can sell these treasuries to domestic U.S. investors, which might be individuals or corporations or pensions, etc., or you can sell them to foreign investors, to non-U.S. investors, which might be central banks, it might be corporations or individuals. So these are the two main ways, basically taxing and borrowing. When the government sells bonds, it is borrowing from people and institutions. Now, why does the government need to issue bonds, issue treasuries? Basically, because of the amount of spending that's currently going on. So if we take a look at the U.S. debt clock here, the federal tax revenue, I believe these are 12-month figures, is about 2.6, 2.7 trillion, and the federal spending is 5.595 trillion. And so we have what's called a budget deficit, where we are spending a lot more money, or the federal government is spending a lot more money than it's bringing in, and that's to the tune of 2.9, call it $3 trillion. So that is why the U.S. government needs to sell bonds in addition to collecting taxes. If we were just living off tax revenue of 2.6 trillion, we wouldn't have enough money to pay for very crucial programs. And these things include the largest budget items: Medicare, 1.3 trillion, Social Security, 1 trillion, defense, about 700 billion. You can see that, and then obviously interest on the debt, just these four big items are no longer covered by tax revenue. So the government needs to borrow money just to pay these mandatory programs. You need to spend money on defense, you need to pay interest on the debt, and you cannot cut Social Security or Medicare. It's just not right or politically feasible. So this is why the government needs to sell bonds in addition to collecting taxes. So we've now entered kind of a brave new world since about 2008, since the 2008-2009 crisis, where the Federal Reserve has been doing something called quantitative easing. Quantitative easing is a fancy word made up by economists and central bankers to distract you from the fact that what they're doing is printing money. Quantitative easing, or QE, is when the central bank prints money and buys things with it. They could buy treasuries, government bonds. They could also buy corporate bonds, junk bonds, which they've started to do in the U.S. in 2020. In Japan, they've been buying equities for many years. And the central bank, the Bank of Japan, now the BOJ, now owns a significant portion of the Japanese stock market. So let's follow what happens when the Fed prints money and buys government bonds. We're going to sort of follow the money trail. Basically, what happens is the U.S. Treasury does these auctions where they auction off these pieces of paper, digital pieces of paper called treasuries or government bonds, and they sell them to primary dealers, groups like Bank of America, Goldman Sachs, etc. These are just big banks that buy the treasuries from the U.S. government. Now, when Goldman Sachs buys a treasury bond from the U.S. government, Goldman Sachs gives the treasury U.S. dollars, and in return they get a piece of paper, a digital piece of paper, in other words, a U.S. treasury or government bond. Now, what Goldman Sachs does after they buy this piece of paper is then they immediately sell it to the Federal Reserve, which is a central bank in the U.S. And the Federal Reserve pays for that piece of paper with newly created U.S. dollars. And so at the end of this process, the Fed has a piece of paper. Obviously, this is all digital. I'll say piece of paper just to make it visual. The Fed has a piece of paper, And its newly created dollars, the dollars that were newly created by the Federal Reserve, have made their way to the Treasury General Account, the TGA. This is like a giant checking account that is used for all the government spending as authorized by the Congress and the President. Now, this is very different, we should notice, than selling that same piece of paper to a real person or an institution in the United States, or a real person or institution or corporation in Europe or Asia. Because most people, most corporations, don't have a money printer in their home office or in their corporate office. The Federal Reserve does have a money printer, which is obviously a digital, it's basically a computer, and they can just create more money on the computer. And so what we see here is that when the Fed buys U.S. Treasuries, it's very different from anyone else buying U.S. Treasuries. When other people buy U.S. Treasuries or corporations buy U.S. Treasuries, they need to have real money that was earned in the real economy. And when they buy Treasuries, it does something called crowd out other investments. If you buy Treasuries, you can't buy stocks or a house with the same money. And so there are real limits in the real world to what money there is that can be used to buy things like Treasuries, whereas the central banks, especially the Federal Reserve, are not constrained by this because they have a money printer. And so what we can say is that all this government spending that we were talking about is being made possible by debt monetization. What's debt monetization? That's just when the central bank buys up the debt that's being issued by the federal government. In other words, you'll often hear this, the Fed is financing our deficit spending because we're spending more than we're bringing in taxes. Now, the Federal Reserve has tried to deny this many times. This is a paper from 2013 asking the question, is the Fed monetizing government debt? And of course, they come up with a conclusion that, oh, no, of course not. The answer is no. The FOMC, that's the Federal Reserve Open Market Committee, has often stated its intention to return the Fed balance sheet to normal pre-crisis levels over time. Once that occurs, the Treasury will be left with just as much debt held by the public as before the Fed took any of these actions. And here's the real line. When that happens, it will be clear that the Fed has not been using money creation as a permanent source for financing government spending. In other words, they've not been monetizing the debt. This is a 2013 conclusion, but if we look here, we can see that this is a chart of the amount of U.S. Treasuries held by the central bank, held by the Fed. When this paper came out, we were right about here, and they stated their intention to return their holdings of Treasuries back down to pre-crisis levels, which was somewhere right around here, late 2007, early 2008. As we can see, that never happened. Instead, the amount of debt held by the central bank, held by the Federal Reserve, has only gone up. And so it's very clear now that this is just another case of the Fed lying through their teeth. There was, perhaps they had an intention to return the balance sheet back to normal, to basically sell off these treasuries or let them just sort of mature and roll off the Fed balance sheet. But that never happened. And it's very clear now, especially in the wake of COVID, in the wake of all the baby boomers getting very close to retirement, many of them are retired already, and all the entitlement spending, the Social Security, Medicare spending that comes with that, that there's no way to stop this. This is why I say the Fed will have to print money for the rest of our lives, simply because the government has to pay Social Security, has to continue funding the military, etc. These are not really items that anyone could realistically see being cut. And so when the Fed says they're not monetizing the debt because they expect their holdings of treasuries to return back to normal, it never happened. It absolutely never happened. And this is very clear to all market participants right now. Here's the total Fed balance sheet that includes not just holdings of treasuries, but other assets, currency swaps, etc. And we can see how it's exploded from really around 4 trillion at the beginning of the year, currently seated at around 7 trillion. And we're going to go a little bit more into those numbers later. Now, this is the question that D Midnight Runner was asking, but doesn't the Fed just create new bank reserves that get locked into a box at the Fed and not spent into the economy? And I hope, as this video will make clear, that this money does make it into the real economy. And we'll use an example. We'll use the stimulus checks because they're a very clear example. the $1,200 stimulus checks that were sent to a lot of Americans a couple months ago, or you could substitute future UBI, future universal basic income, which I think is definitely coming, where the government just sends people free money every month. Obviously, this would be kind of a continuation of policy under COVID and sort of making a crisis measure permanent. So how would these stimulus checks work? Does the money make its way into the real economy? Well, it obviously does. Let's look at perspective number one. New U.S. dollars are printed by the Federal Reserve, by the central bank. They're sent to Goldman Sachs, who gives them to the U.S. Treasury, who mails checks out to the public. People deposit these checks into their checkings and savings accounts, and that increases the M2 money supply. In a minute, we'll talk a little bit about what the different measures of the money supply are. But here's the exact line where money is printed by the Fed and makes its way into people's bank accounts. And this is quite obvious. What people will focus on, who want to pretend that this money is actually locked up in a box, they'll focus on the path of the paper, of the path of the government bond, rather than the path of the U.S. dollars. And these are obviously, there's an exchange that's going on here for dollars, for pieces of paper. And so I think we have to look at both sides of the ledger to be fair. But basically, new U.S. dollars printed by the Fed do end up in people's bank accounts. It's quite obvious for anyone who got a check. Perspective number two, the U.S. Treasury, in order to raise this money to send out checks, sells Treasury bonds, sells government bonds to Goldman Sachs, who sells them to the Federal Reserve, who keeps them on their balance sheet. And as we saw here, once these treasuries end up on the balance sheet, it's a little bit like the Roach Motel. They never, or Hotel California, and they never check out again. They may mature, but then the Fed buys more and replaces them. So you sort of have these two paths where U.S. dollars make their way out into the economy, and this piece of paper, this IOU from the federal government, makes its way onto the Federal Reserve balance sheet. As we said, the Federal Reserve's balance sheet has been growing since 2008, mostly caused by buying of U.S. treasuries. It tried to shrink its balance sheet in, we can see here, in 2018, 2019. And when it did it in 2018, it sort of caused a mini stock market crash. The market is not able to withstand the Fed drawing down their balance sheet. And we actually got a repo crisis late in 2019. And we can see that the Fed started to grow their balance sheet really in the third quarter of 2019 because of this repo crisis, which was a funding crisis, a crisis in the funding of U.S. government debt, simply because there was too much of it. It was overflowing hedge fund balance sheets and bank balance sheets. And so the Fed became the buyer of last resort. So they, even if we hadn't had COVID, they would still be buying U.S. treasuries and monetizing the debt. And so the Fed was unable to shrink their balance sheet in 2018 and 2019, and now certainly with the slowdown caused by the COVID crisis, they're not going to be able to do it. What this has done is really drawn forward the entitlement crisis, the Social Security and Medicare crisis that people have been talking about for so long, not to mention all the additional government spending that's necessary due to rebuilding because of COVID problems, all the bailouts, etc. Now let's back up and talk a little bit more about the money supply. There are basically two main ways that new U.S. dollars can be created. The first way is that the Fed can print new U.S. dollars. This is what we've been talking about. They can print new money using their special money printer. This is called base money, monetary base. You'll hear different terms. M0 is another term for it. So that's the first way. Fractional reserve banking is the second way. And this basically happens when banks receive deposits and lend out the money, thus creating more money. And I'm going to show you briefly how this works. I'm going to use very big round numbers. So let's say you deposit $1 million in your savings account at Wells Fargo. What Wells Fargo will do in our current fractional reserve banking system is they'll keep 10%. These are rough numbers, but this is approximately what happens. Wells Fargo will keep 10% or $100,000, and then let's say they'll lend out the rest, and they'll lend it out as a mortgage, $900,000. So someone uses that mortgage to buy a house. Let's say they put down a 20% down payment, and then they put down 80% is paid using this mortgage, which will be $900,000. Now, the person who's selling that house, once the house is sold, will take that $900,000 and deposit it into their savings account. Let's say they do it at a different bank, at Bank of America. And then Bank of America will do the same thing that Wells Fargo just did. They'll keep 10%. They'll lend out the rest, the other 90%. And what this, you can see that this is basically expanding the money supply and creating new dollars in the form of debt. Now, what happens in reverse? Well, when banks are lending, it increases the money supply, as we've seen. When debt is being paid off, the money supply is shrinking. So when a loan is paid off, money is actually destroyed. Someone takes, let's say they take $900,000 out of their savings account, they pay off the debt, and the debt is gone, and the $900,000 is gone. And so this is how the money supply expands and shrinks. And when the U.S. financial system, when the banks are not doing a lot of lending, this is one reason the Fed steps in and prints new money. Let's briefly go over the terminology, because you'll see this around, and you'll probably see it in future videos of mine. M0 is physical currency, paper notes and coins. See, these are different levels of the money supply. So that's M0, just dollar bills and coins. M1 includes M0 plus checking accounts, what are called demand deposits. It includes a couple other small things, but it's basically M0, so all the paper money and coins, plus checking accounts. That's M1. M2, and again, these are measurements of the money supply. M2 is just M1, so physical currency, checking accounts, plus savings accounts, money market accounts, money market mutual funds. And you can see that as we progress down in this direction, things are getting less liquid. So coins, very easy to spend. Checking account, it takes a little bit more time. You write a check and the check has to clear. Savings accounts sometimes have withdrawal limits. Money market accounts have to be liquidated before the accounts are before the money can be actually spent. And so this is kind of a measure of liquidity as well. But the most common measurement that you'll see that most people refer to is M2. The government used to report M3, which includes some other forms of money, and M4 and M5. I'll link to the Wikipedia article on that so you can read about it. But M2 is really the one that most people are focused on and seems to give enough information. And then finally MB, which is, that's one abbreviation for it, which is the monetary base we were talking about. And this includes the actual physical money that's printed by the U.S. government. So paper notes and coins, physical currency, plus what are called Federal Reserve deposits. This is special deposits that only banks can have at the Federal Reserve. So the central bank, the Federal Reserve, is sort of the bank for all the other banks. And banks like Goldman Sachs or Wells Fargo or Bank of America have accounts at the Federal Reserve. And that's this is what Federal Reserve deposits are. So we return to our original question. Does Fed money printing cause inflation? Well, it really depends a lot on what they're spending the money on that they print up. So if the Fed buys mortgage-backed securities, which they did during the 2008-2009 crisis, this was a way of sort of taking it off of the commercial bank balance sheets. They're also called MBSs, mortgage-backed securities. These are basically packages of mortgages that are traded on Wall Street. So when the Fed buys MBSs, corporate bonds, including junk bonds, which they've been buying this year, the money mostly goes to Wall Street. It goes to the wealthy. It goes to people who own stocks and bonds and real estate. This is the Cantillon effect, which we talked about, that those who are closest to the money printer, which in this case would be people who are in finance and Wall Street, they benefit disproportionately. This includes people in private equity, for example, who this is basically where Jerome Powell comes from. He has a private equity and investment banking background. So the wealthy benefit disproportionately from this sort of quantitative easing, this kind of money printing. And the way it affects stock prices, even if the Fed's not buying stocks directly, they are basically guaranteeing corporate bonds. They're keeping corporate bond interest rates low. They're keeping interest rates low at the general level of the economy by buying treasuries. And so this translates into higher asset prices, higher stock prices, higher real estate prices. Now, what do the wealthy do with most of this wealth? Well, you can only buy so many houses, so many cars, so many private jets, etc. And so most of it is still kept in financial assets. It's kept parked in stocks, maybe multiple homes, commercial real estate, and other financial securities and instruments. And what this does is this causes what we've seen, which is asset price inflation. PEs on stocks stay high. They've stayed high since the late 90s with various dips, but they've kind of reached a new permanently high plateau. And so stocks are very expensive on a valuation basis. This is why value investing doesn't work anymore, because of central bank interference. And it's also why younger generations, the millennials and Generation Z, cannot afford the same houses that baby boomers, and to a lesser extent Gen X, were able to afford. This is how the Fed affects real life. Now, and I should say exacerbates wealth inequality. Now, when the Fed buys treasuries, so in this first case, they're buying mortgage backs, they're buying bonds, etc., and they're keeping asset prices high. When the Fed buys treasuries, as we saw, that money actually makes it to Main Street in the form of regular government spending, because the government's doing the U.S. federal government is doing deficit spending. They don't have enough money from taxes, so they have to borrow money to pay Social Security, Medicare, military spending. So if you're at the receiving end of any of these, maybe someone in your family works in the military, or you receive Social Security or Medicare, you are receiving money that is being printed up by the Fed. It could not make it to you on the basis just of the U.S. government collecting taxes. They don't have enough money coming in. And so this is an example of where money printing does make it to Main Street. It makes it to regular people. And this is money that's just been printed up out of nothing by the Federal Reserve. And obviously in the case of universal basic income, helicopter money, stimulus checks, political bribe checks that are given to the American population so that to encourage people not to riot or whatever, this would also be money that makes it to Main Street, and it's directly coming from the Fed's money printer. So to review, that first category really causes asset price inflation. It makes stocks and bonds and real estate and gold and Bitcoin go up. If you look at what all of these have done over the last 20 years, or certainly since 2008, they have just gone straight up. This is asset price inflation. This is what you could also call monetary inflation, where the money supply has been increasing, and so it doesn't. Each individual U.S. dollar is worth less, and so the prices of scarce assets. So the Fed cannot print more real estate. They can't print more gold or Bitcoin. These things go up in price, and I would point out that asset price inflation also causes some levels of consumer price inflation simply because it keeps real estate prices high. So the cost of living is higher for everyone. And it's disproportionately higher for those who had to buy a house since 2008 or 2009. They have much higher cost of living because if you bought a house before that, you sort of locked in your price, your cost of housing. And so this is one way that asset price inflation kind of bleeds into CPI inflation, or it should if CPI inflation were measured honestly, which it's not. Yes, the second category where we actually get universal basic income, helicopter checks, stimulus checks, this can cause consumer price inflation directly simply because it's going straight into the economy. It's not really going through Wall Street. And it will cause inflation if the money's being added more quickly, or if the money supply is growing more quickly than the economy itself is growing. Obviously, right now, the economy is fairly stagnant, and so we are at a risk of inflation. This is a controversial area I've done a couple videos on how the CPI is calculated. If you look at something like the Chapwood Index, for example, you can see that we've had consumer price inflation much higher than the official statistics. It's been closer to 8 to 12% a year for the past few years. Now, this Fed money printing is one reason why the rich have gotten much, much richer in 2020, while the poor, or the working class, or the middle class who don't own as much stocks and real estate, have gotten poorer. Let's take a look at, so now that we know the different levels of money supply, this is the M2 money stock, or the M2 money supply, and we can see how it's moved this year. So at the end of last year, it was at about 15 trillion. Now it's at about 18 trillion. I'm trying to make these numbers line up. They're a couple weeks old. But basically, the U.S. money supply has grown by $3 trillion basically 20% over this year. This is just unbelievable money supply growth. Meanwhile, the Fed balance sheet, the assets on the balance sheet, has grown from about 4 trillion to about 7 trillion. So money supply, M2 money up 3 trillion, and Fed balance sheet up about 2.8 trillion. So basically, this increase in the M2 money supply, 92% of it was driven by the Fed expanding its balance sheet. And this is what D. Midnight Rider refers to in his comment, which I'll link to, about how the commercial banks aren't lending and the real growth in the money supply is coming from the Fed. So one can say, in a sense, the Fed is making up for slackness in the lending markets. But on the other hand, it's massively growing the money supply. And it needs to do this not just because it wants the M2 line to slope up, but just to keep bringing it back to this. It's because of this deficit spending. The U.S. Treasury has to keep issuing government bonds, and there are not enough buyers domestically, and there are not enough non-U.S. buyers for this. The Fed is the buyer of last resort, and that is the real reason that they're printing money, not necessarily to make up for some shortfall in bank lending or some conservatism in bank lending, but simply because someone has to take these treasuries down and hold them, and the Fed is the buyer of last resort. To conclude, I'll link to a video. I know D. Midnight Rider in his comment refers to Japan and why Japan has never had inflation. So I'll link to this video. The story of Japan and quantitative easing and money printing is a long story. The short version of it is that Japan has the yen, which is not the world reserve currency. They're very dependent on commodity imports, and so they are not willing to devalue their dollar, devalue their currency in the same way the U.S. is, because the U.S. can print money for oil, can print money for commodities. So that's the Japan piece of quantitative easing, if you want to delve into that. And this is what people always say, that quantitative easing doesn't cause inflation because of Japan. So I sort of debunk that in this video. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell so you can be notified when I post my next video. And let me know your questions and comments in the comment section below. Hopefully I've explained this clearly. It's a fairly complicated story, and a lot of people try to sort of unnecessarily simplify it based on what they want to demonstrate. But I hope I've given a balanced perspective here. One way that we know that there has been money printing is that the US dollar is constantly, over my entire lifetime, has lost purchasing power. A hamburger used to cost 40 cents, now it's $4 or $5. Real estate prices have gone up, gold prices have gone up. And this is one measurement of inflation, the loss of purchasing power of the US dollar caused by Federal Reserve money printing. Thanks a lot for listening, and I'll see you in the next video.